Hello, everyone. Thanks for joining us. My name is Dave Lubnick, and I am joined here by Shirl Penney and Ryan Shanks. And I'm very excited for the next 45 minutes or so to speak with these esteemed gentlemen in the financial advisory space, pick their brains a bit on some of the topics that are near and dear to their hearts, and also field questions from all of you. So I'm going to kick it off here with some bios. First of all, Dave Lubnick with YCharts, heading up business development, institutional sales. For those of you that might not be very familiar with YCharts, our mission is to enable advisors to help them make better investment decisions. That takes the shape of investment research, market data, as well as client communication, and even portfolio construction and building portfolios. Along those lines, we've had great relationships with both Shirl and Ryan for a long time. Let's start with you, Shirl. I've known you for about 8 years. We've had an enterprise relationship with Dynasty for most of that time frame. Tell us a little bit about your background, your story growing up in Maine and now in Florida.
Thanks, Dave. Thanks for having me. Thanks for YCharts. As you mentioned, great, almost 8-year partnership. One of the most popular technologies on our platform, to be candid. Our advisors absolutely love it. So I'm excited to be part of this. And Ryan, great to see you, old friend. Anytime I get a chance to interact with you, I'm excited to do it. So yes, we're all living our own version of the American dream. As you mentioned, growing up in Maine, I came to Manhattan with a dream of working on Wall Street in a $13 suit that I bought at the Salvation Army, and pretty quickly worked my way up the ranks at Smith Barney. Actually helped build and ultimately run the private wealth management business, which was the part of the organization that focused on some of the larger client relationships, worked with some of the top advisors and producers within the firm, and saw that a lot of the top advisors in the industry were starting to look to go independent. This is back in 2000, call it 5, 6, 7 in that range. Saw that asset flows were starting to pick up to go to the independent space. And thought that this would be my opportunity to become an entrepreneur and build a business that took advantage of the migration towards the independent space. So in early 2008, left and started Dynasty Financial Partners with the original founders of the business. And Dynasty today is the largest fully integrated platform serving some of the higher end RIAs in the country. We provide all the integrated Fintech, investment platform access, capital when and if needed, to about 320 advisors inside of 47 RIAs now that in aggregate serve over 75 billion in assets. So thanks again for having me, Dave.
Absolutely. Thanks, Shirl. And Ryan, I'm not sure there's a better person in the industry or a more well-connected one than you. I feel like every time I see you at a Schwab or TD show, you've got a group of folks just following you around, wanting to get some of your time. Tell us a little about yourself with FA Match and your prior business as well.
Thank you, Dave. And thank you for having me. And Shirl, I couldn't agree more. It's good to see you and it's good to be joining you here. So, my journey's been maybe some similarities to Shirl. I come from a small town in New Mexico. It was oil and gas, and I dreamt of getting out of there. And you fast forward, and when I got into the recruiting space for financial advisors, which was 22 years ago, I recognized quickly that advisors were being sort of almost forced to go and talk to firms versus determining compatibility and what was missing. And so from a very, very early start, I started realizing that if I could somehow diagnose what was wrong with the firm the advisor was with, I could potentially help prescribe what might be right elsewhere. And that underlying DNA carries forward to where I'm at today. I sat in the seat of head of biz dev for 2 independent broker dealers. I ran a consulting firm, Fine Tooth Consulting, where we essentially were the first firm in the industry to say we're going to represent the advisor and their clients in the transition space versus any firm. And then FA Match that we've launched in 2018 has really been built around an automated compatibility engine, reducing the cost so that the entirety of the marketplace can afford it, but focusing most on the fit.
Wonderful. So everybody can see here the agenda. As we go through these topics, I encourage you to submit questions. I also think everybody's going to really enjoy the fact that both of these folks are entrepreneurs, and this is really about serving entrepreneurs. That's really their business models. It's a lot of whom YCharts is serving as well. So I think this is going to be exciting. We've got some topics here talking about, successfully transitioning to that state of being your own CEO, how you think about it from an economic perspective, how you think about it from a tech stack, and common oversights that you want to, make sure you don't take, mistakes that you don't make. I'm sure these guys have seen a lot of them over the years. So with that, let's dig in. And I'm going to start this off with actually a little bit of a story about myself, which is the fact that for 4 years, I was an advisor at Goldman Sachs, private wealth advisor at a large wirehouse serving primarily individuals, 10 million and up 10 million and up of investable assets. At the time, I didn't know Shirl or Ryan, but I certainly reflect on how my life might be different if I had, because at a large wire like that, obviously a lot of folks on the call know, there's bureaucracy that comes with it. There's red tape that comes with it. There are significant, kind of fee sharing that goes along with it as well. So kind of with that, let me kick it to you first, Shirl, to talk about when folks are thinking about just that first inkling of going independent. What would you say to them? And talk about, kind of the experiences that you've seen over the years.
Yeah, thanks for that, Dave. One thing I would say just up front is the most successful breakaways or some of the larger businesses that we've helped launch, the motivation for the advisors, there might be some frustrations, but their motivation is really about the excitement to go build something. It's what they're running towards, not what they're running from. And to be candid with you, we spend very little time talking about anything that's negative or frustrating them about where they might be currently. And we spend the vast majority of our time educating them about what it's going to be like owning and operating, running their own business, or maybe what it would be like joining another RIA. So the most successful advisors, again, on launching businesses are the ones that are laying in bed at night and you just can't stop thinking about it, right? As entrepreneurs, and Ryan can relate to this, and you can as well, Dave, where you're just, it's not work, right? Most of the time, because it's your baby, it's your vision, right? You're excited, to work within your own business. And those people that really speaks to and resonates with, those are the ones that are most successful. But what I always say to people to get started is to get educated. And you can't really get educated too soon. I think the best education oftentimes is peer-to-peer. So talking to other advisors who've successfully navigated, whether it's going from an independent broker-dealer to full RIA, or going from a wirehouse or bank model, captive model to an independent firm, talking to them. There's a lot of great consultants that are in the space. I think Ryan certainly is one of those. There are some recruiters out there, although I do tell advisors they should definitely ask for transparency and how those recruiters are paid, because sometimes they're paid more to direct advisors through, to certain firms or certain models. There are integrated platform providers like Dynasty. If you're a rugged individualist, if you fantasize about building your own house someday, then maybe you don't need a platform partner. But if you hire a general contractor to help you bring your vision to life, then maybe you want a partner like Dynasty. So there's a lot of resources that are out there to help advisors get educated. Just don't try to figure it out on the battlefield, right? I tell advisors all the time, right? If you're going up against kind of the Navy SEALs, you don't want to be learning to shoot the gun for the first time while you're out there. So the more time and effort, the battle is won before the first shot is taken, that you put up front, the more success that you'll have at the time of transition. And the last thing I'll say, and I'm sure Ryan has some thoughts on this, we have over the last, almost 12 years, we've transitioned hundreds of advisors at this stage. We've curated 175-step detailed process. Everything from naming, branding, logo, websites, finding real estate, HR, setting up billing, tech. I mean, there's a lot to it. It can be a full-time job, but at this point, the road, the path to independence, it's no longer a trend. It's a movement, and that road is well worn. So there are many ways today that you can be independent but not alone. But just start by getting educated.
Yeah, that's great. Ryan, what would you add to that?
What I would say is especially if you're in a captive state right now, so you're working for some wirehouse, regional firm, or bank, there's the risk, right? It's going through sort of that risk spectrum in terms of the things you're comfortable taking on yourself. Do you want to go build it? Do you want to go join it? And as Shirl said, do you want to be responsible for the utilities? Do you want to be the one digging the ditch and laying it? Do you want to just come into it and it's turnkey and you can provide the most incredible support and care to your clients? But that risk conversation on the very front end is, in my mind, one of the most important. And it's typically a conversation that doesn't happen often enough. And we talked to advisors who broke away and were convinced they should go build it 18 months after the fact. And they're just so caught up in the weeds of just the business itself that they're what they loved about the business they've gotten away from, because they have no choice but to wear all those other hats. So we work with them to really help. And my advice to anyone listening right now is really look in the mirror and ask yourself, do you want, as Shirl alluded to, want to go out there and build it? And you have that desire and that trust in yourself that you believe you can be successful in something you've never done, but you can still reach independence with a support mechanism in place, such as what Dynasty provides, where you don't have to be figuring out the utility, figuring out how they all plug in and whether they work. You can actually turnkey it and you can focus on serving those clients. And the most beautiful thing about that evolution from an economic growth perspective is the enterprise value that is gained by just getting those clients out of that captive container on the independent side. And
you talked a little bit about the liability side of the balance sheet there, thinking about what folks are going to have to, go out and get, such as real estate and internet and so forth. Talk a little bit about how you work with them, thinking about what fees they might charge when they think about what they, want to price themselves at, looking at industry peers and so forth. What does that kind of process look like? Because I imagine it's very relevant as they're also thinking about all the costs associated with it.
Yeah, I'll jump in, Ryan, on that one. So for us, we run a very detailed P&L analysis for any advisor that's contemplating a move, and we do that for RIAs that are thinking about outsourcing to us. We do it for IBDs that are transitioning, for breakaways as well, and entrepreneurs, for the most part, certainly negative surprises. We don't like surprises, right? So. For us, we're professional translators, right? So I grew up in a wirehouse. I've been in the RIA space, for the last, 12 plus years. So we speak both languages, right? So we're able to look at, things like production and advisor comp and translate that into what your fixed costs will look like, and then your variable costs to get you to a gross income, advisor comp to get you to net income, right? Helping advisors kind of go from advisor to CEO. And then in detail, understanding what the cost associated both on the fixed and variable front will be, so that they understand the profitability. We then take it out, and I find this to be very helpful, Dave. We take it out 5+ years so that they can see how that business is going to evolve and grow, how they can get margin expansion in the business, how the enterprise value that the firm that they now own, how that is going to increase over time. And at this point, we run the books and records for all of the firms that we support. So we have really great data. And we have something we call OCFO, which is a dashboard. It's proprietary technology that we built 6 or 7 years ago that aggregates the peer comps on the P&Ls of all the advisors that we support into the hand of the advisor, so that they can have their business plan for the year with all of their financials porting in and seeing how they're doing versus their plan. And they have business analysts on our team that support them. But then I think importantly, or as importantly, they can see how they're doing relative to their peers running other businesses in our network. But if you put the work in, as we said up front here, there shouldn't be any surprises around the economics, because there's been at this point literally thousands of advisors that have gone independent. So there's a lot of collective learning if you're plugged into the right places that you can learn from around the economics in advance of a move.
Right. I know at FA Match, a lot of what you're doing is sometimes matching up advisors, whether they're already independent or not. How do you think through scenarios where there could be advisors coming at a marriage with a different economic background as far as that goes?
Yeah, I mean, I think, again, if you're coming out of a captive environment, it's always so simple to do the math, right? You're getting 35, 40, 45 cents on the dollar. The firm is getting the difference, and oftentimes there's lift above that 100 points that's never shared back with that advisor, especially in those wirehouse environments. So it's simple to be able to go through and do the math. But I think, to kind of get to the core question that you asked that Shirl was addressing, how do you help an advisor determine what to set in the price schedule, the ADV? It's really a function of what have you done historically? What have you been hamstrung in providing to the end client in terms of support and service? Can you increase that? Because oftentimes what we see is the advisor can break away and they could actually, in a lot of instances, reduce the cost to the end client, but still generate phenomenal margin in that independent landscape, right? So it really, again, it depends on that advisor and their desire to want to either build it or to join it. But I'll dispel a myth right now for everyone listening. The economics are not always greater if you go and build it. More often than not, the economics are actually greatest when you plug into the right infrastructure, where there's that efficiency, there's that scalability, there's that leverage from a custody perspective on price, right? I just had a conversation today with an advisor. It's got about $100 million book. That book over at Schwab isn't going to get him the same pricing as it would through some company that's got 5 to 10 billion in assets, which turns around and converts to savings to that end client.
Yeah, and just to further underscore what Ryan said, because I think it's a really great point, Dave. Again, we are really focused on data here. So the average advisor firm on our platform right now in terms of gross income, right? So sometimes people talk about that as EBOC, but it's really what an advisor, assuming they own 100% of the business, what they could take home is averaging in the mid 60s. That means their total cost, their fixed cost, which is their real estate and their people, and the variable cost, right, which is the 50 different vendors that are integrated with all the proprietary tech and our 100 people and everything else, is all tied into the variable cost component, and they're keeping 65%. So for somebody that is breaking away that might be in the mid 40s or 50 range, it's tangible both in terms of increased cash flow and increase net worth because they're owning the equity in that business that's going to continue to expand over time. Interestingly, to the great point I think that Ryan just made, when we look at $1 billion RIA that comes to us looking to outsource, on average, they have 5 more people and they're paying more for third-party vendors because they don't have the scale that we have. So most of the $1 billion firms in the space that we run into are in the high 50s, right, in terms of the gross income. So you're looking at 4 to 5 points of pickup of enhanced income. And multiples are at all-time highs, as we know. If you put a 8, 9, 10 multiple on that firm could be worth a third more in terms of enterprise value by outsourcing. And then they free up their time, right? Rather than managing a tech stack and a vendor stack and 5 more people, right? They have more time to take care of clients and go get new ones. So I love the point that Ryan made. So just thought I would underscore it a bit there.
And you just touched on an interesting topic, I think there, Shirl, with the multiples that firms are commanding now. So walk us through, both of you, the kind of conversations you're having with folks now and maybe how it's evolved from where it might have been a year or two ago around that concept of, is it maybe a sale? Is it a capital raise? Or is it some other option on the table for an advisor right now?
Yes. Meaning all of the above. It really depends on where an advisor is in their life cycle. But we are seeing conversations around all of those things. Somebody might be looking to sell a business. Sometimes if they're looking to maximize the value, you get a banker and you run a process and you're less concerned about structure. You're less concerned about the partnership, perhaps connectivity, and you're just trying to maximize a trade. It's your business. Whatever's most important, to the advisor, they can do it. But sometimes there's not perfect alignment between the partnership, the structure, and the price. And I always like to say, to someone who's contemplating a sale for the first time, is you tell me the price and I'll tell you the structure, right? And a lot of advisors don't fully appreciate, like if you're listening to this conversation and you don't know what a PIK is, you don't know, what preferred return, downside protection for an investor. If you don't understand those concepts, you're probably not ready to go out and have those conversations with private equity, with serial acquirers, right? You need to get yourself a lawyer, an accountant, a consultant, right? Somebody that's been around the block and does this for a living, to help educate you and represent you in those conversations. Because I meet advisors all the time at conferences where they'll come up to me and they'll say, hey, look, I sold to, this entity. It's not been exactly what I thought. And I say, well, who else did you talk to? And they say, well, I didn't really talk to a broad range. I just seemed to really like the person, and I did the deal. But now they're looking to get out. And a lot of these agreements are not flexible. They're ironclad. And once you sell even a piece, forget about selling the whole thing, it may be irreversible. So getting a good group of advisors around you and understanding what's most important to you. Is it partnership? Is it culture? Is it structure? Is it flexibility to buy back your equity over time if it's not the right fit? Is it value, right? I mean, there's those things, again, are not mutually exclusive and not always aligned. And talking to peers who've made mistakes, who've been through the process before, I think is invaluable. And there is, like I said earlier, about breaking away. Same thing with M&A. You can't start getting yourself educated too soon before you go down this path.
Those are some great perspectives. Ryan, anything you'd add there from your perspective?
Yeah, I mean, I think, you talk about partnership, right? We're talking about breaking away, forming an RIA. If you're looking to do it with a +1 or a +2, be really, really thoughtful about who they are. I've had so many conversations where they've just jumped in, structured the deal. There's 3 partners. They've got a third ownership each. And then 12 months into it, 2 of the partners are looking at the third going, wait a minute, we're hustling. You're not doing much of anything, but you have the same stake and we want to do an about face and we want to sort of regroup on this. And it's difficult to do. So I've seen scenarios where they're trying to sort of unwind that. So be careful about who it is you're going to ultimately try to be partners with in doing it. The other thing that I would say is that when you think about becoming this RIA and scaling and growing, don't make it about you and try to be really thoughtful about you not being the bottleneck, right? So that things don't all flow through you, because as you evolve and you get to that tail end of the spectrum where you're really ready to try to sell, the companies that are selling for a higher multiple are made up a lot of different components. It's the age of the clients, it's the duration of those clients to be repetitive in a revenue flow in the future, but it's also systems, processes. It's the ability for somebody to step in and flip a switch and for that company to not miss a beat versus that individual being that bottleneck. Like I got a client right now, they got $1 billion in assets. I was talking to the founder and I said, do you ever just stop and just kind of clap, like, look at what you've done? You think back when you started on this journey, you probably never thought you'd ever get to $1 billion in assets, and here you are. And he's got a phenomenal company structure. Everyone comes in as an employee that he hires as W-2. He pays very, very competitively. Everything is managed on an outsourced basis. And so the advisors are all in particular roles, so it's repetitive. And it's got significant enterprise value. So he was sitting here thinking that his business had $30 to $35 million valuation. And I told him, because of how thoughtful he's been, which was just part of the DNA of getting to where he's at, I said, it could be closer to 50. And so he's sitting there wondering, do I take chips off the table because the market's high, right? Or do I continue to go on this journey and let the next generation try to, sort of do a 2X on this? So it's a pretty fascinating, space that we're in right now. Shirl, I know you guys see a ton of these firms that are, really in that $1 billion mark. It's ridiculous the amount of money that wants to be thrown out there, but be very thoughtful about the terms and what you're going to lock yourself into.
Yeah, and who the buyer is, right? There could be ancillary businesses, there could be expectations of distribution of products. Sometimes, it's hard to read the fine print or know what it is. So again, the more peers you can talk to and outside advisors like Ryan and others that you can work with, the better. But I just quickly would say, Dave, because most of these comments that Ryan and I made were for someone who's on the sell side, meaning an advisor thinking about selling. On the buy side, there's a tremendous amount of advisors now that are entering into the M&A arena, and they want to grow not just aggressively organically, but inorganically, meaning adding other advisors. It's a very competitive landscape. So I would just advise everyone, if you're coming at it from the buy side, you have to be M&A ready. You have to have all your documentations, your equity structures, your comp plan in place. You have to have kind of that investment banking roadshow deck that's ready to go out. And as Ryan said, that right up front tells the person not only who you're looking for, the ideal candidate, but who you're not, right? And really know, who your candidates are, to know what the economic model is in terms of how you're going to onboard them, how you'll integrate the technology, how you'll facilitate the transition, because the firms that are in this great rhythm do that really well. And if you want to compete with them, you've got to up your game to be ready and to be successful.
Yeah, that's great. And before we move to the tech stack component, I just read this recently, Shirl, that you guys kind of along the lines of what we're talking about launched a partnership with MIT Sloan, I believe, advisor to CEO.
Yeah.
And I think that's upcoming next month, maybe. Talk about that a little bit, because I think that's very relevant to what we've been talking about so far.
Yeah, no, thanks for that. Look, we fundamentally believe the firms that win disproportionately from others are the ones that have the best leaders, right? And I think intuitively we all get it, but we're all so busy as entrepreneurs working in our business, we don't take a step back to work on the business. And what we're trying to do is be very deliberate in partnering with our advisors to create mental space and physical space, in the case at MIT, where they can step back in a peer-to-peer confidential environment where we say no masks, meaning come in and be yourself and really admit all the things that you're struggling with and lean in and learn from each other. It's a quarterly program where we have content, everything from marketing to operations to personnel, leadership training, et cetera, financial analysis training over the course of virtually quarterly. And then it culminates with a 3-day offsite at MIT. You're right, Dave, it's coming up next month. We limit the group to 20 CEOs within our community so that it can be very hands-on and engaging. But I can tell you the feedback has been phenomenal. The excitement and enthusiasm around it, because again, advisors, they want to invest in their own professional development. I find the best ones oftentimes want to be independent but not alone. And at different times in their journey, they're all facing the same issues. So the ability to come together and to have it be facilitated, with a world-class institution like MIT in partnership with Dynasty, it's something we're excited about, and we're going to build on it. It'll be collective learning. Hopefully, it'll be better every year, and it will be a store of knowledge that can benefit the RIA advisory space.
Yeah, that's great. So then moving on to our third topic around the tech stack, we've talked about some of the items that an advisor is going to have to think through, whether it's real estate and branding and so forth. But clearly, tech stack is going to be an important piece of that. And I think this conversation is interesting on the heels of the news just earlier this week of the Orion and Redtail merger. Ryan mentioned Schwab earlier. I mean, obviously, there's been consolidation in the custodial space as well. So when you have those conversations, maybe Ryan, I'll start with you, because you might also be working with advisors coming into a merger with different tech stacks. What do you think about when you're looking across those tech stacks? What do people need? What are nice to haves, need to haves, and how do you approach that?
Yeah, I mean, I think it's CRM is typically one of the most important components. That's sort of the nucleus that sort of feeds into and drives everything else. But we typically, again, we don't get into the weeds on technology, but we know enough to sort of put them in the right place. But it's going to be CRM. It's going to be your financial planning, any type of research tool. You'll have a trading application that oftentimes could be a part of, a financial planning tool. You're going to have portfolio risk assessment, and you're going to have, some accounting systems, some communication tools. You're going to have online scheduling is going to be sort of a core of what you're going to want to have to kind of get out there in the field. And then from there, you start to, the thing about it is, and Dave, hopefully you can appreciate this, there is so much new technology that's flowing into this vertical. And what I got to tell you, what gets me more excited than anything is the fact that, it used to be that the wirehouse had the superior technology and the superior experience. And man, this independent landscape has just run laps around them. But part of the issue is that you have so much choice. So when we're talking to an advisor that's considering Breakaway, we want to really kind of put it in a container that, talk to me about what it is you've been doing for your clients in the past, what you want to repeat about that experience, and then go and learn how you could be even better than you've ever been by leveraging some of these different technologies. But frankly, organizations like Dynasty, have got phenomenal resources internally to speak to it. You know, the custodial platforms out there, the Schwabs, the Fidelities, the Pershings, they got incredibly talented people out there that really know best of breed technologies that'll interface best. So essentially what you want to do is, it's similar to what I used to do when I started recruiting. Find out what the diagnosis is and then try to prescribe what's applicable to that individual advisor and their needs, right? Because one size doesn't fit all.
Yeah. I would just add to it, look, yeah, Dynasty is a wealth technology company. And one of the challenges, you know, with technology for any organization is over time, it becomes dated, right? And some of the large firms, to Ryan's point, you know, who have technology that in some cases is north of 20 years old, the challenge that they have is, first of all, massive tech debt, meaning that the ongoing developmental costs become substantial, right? And the cost to upkeep drags on earnings and forces them to continue to invest a lot in that legacy infrastructure. But new startup technology evolves and leapfrogs a lot of that technology that is legacy tech. But it's very difficult, you know, if you have 18,000 advisors and millions of accounts, literally, that are on that technology, you can't just rip a Band-Aid off and say, you know what, you know, we've been running it this way for the last 22 years, but now we're just instantly going to outsource it, right? So that is a huge advantage, as Ryan highlighted, that when we launch a new RIA, we are curating and building custom technology and infrastructure just for that firm based around how they want to service their advisor. It's just it's a huge advantage. But you're right also, Dave, with a lot of advisors, it can be the good and the bad about being here on the independent side is you can do whatever you want and you can run into shiny object syndrome. And there's a lot of technology salespeople that are constantly in your office. And we run into RIAs all the time where they've bought all kinds of software. It doesn't integrate. And I always say to them, look, if it doesn't make you more efficient or it doesn't help you better connect or serve your client, why do you have it? Right. And I think most advisors, if you said it's a B-level technology chassis, but it integrates versus A-level individual components with no integration, most advisors, not all, but most would take B-level with integration. And what we've set out to do with Dynasty is to say, don't settle. We believe that you can integrate best in class through the Dynasty desktop, fully integrated, where we take our proprietary technology and build it out alongside of best in class reporting, financial planning, compliance software, TAMP technology, et cetera, so that advisor can get best in class individual components with integration that provides simplicity, efficiency, drives scale, and allows them to take better care of their clients. That sounds maybe easy enough to do. It's in the better part of the last 12 years, and it's a work in progress. But on the whole, as Ryan said, I do think it is an advantage today. That wasn't the case 20 years ago, but the access to technology in the independent space, frankly, is far superior than what you see for the reasons I mentioned in some of the larger brokerage and independent broker dealers.
Yeah, no doubt. I remember going to my first Schwab Impact, which I think was in 2013, and there was maybe about 10 fintech companies in kind of their market square area. Now I think that's probably north of 80 or 90. So there certainly has been a proliferation of fintech companies to service the different needs of the tech stack. And I think you guys both hit on a kind of a nice balance that advisors are probably looking for. It's that not overbuying, not always purchasing the shiny object, but also having the confidence that you don't need that system that you had at the wire that's been around for 20 years and hasn't seen many enhancements and so forth. So where's the happy medium between those two?
Yeah. One of the things I wanted to share real quick, Dave, is I just want to kind of give a shout out to TD Ameritrade, because I really do believe that they were one of the pioneers in really driving integrated technology that we've seen carry over in the RIA space.
Yeah, absolutely. They've been great. So with maybe the remaining 10 minutes or so that we have here, the fourth topic, common oversights to avoid on the road to independence. Love to hear your thoughts, maybe some funny anecdotes here as well of mistakes that you've seen along the way, and what folks who are contemplating this, thinking about independence or mergers and acquisitions and so forth, might want to learn from others on.
Want to go first, Ryan? You want me?
Sure. Yeah, sure. I mean, I think the elephant in the room is, all right, I'm an advisor at a wirehouse. I want to go and I want to make this leap. Will my clients come with me? So I think going through an exercise around retention is critical, because the output of that is going to be able to drive whatever the top line revenue is. And then based upon however you choose to sort of launch the company, your affordability, which is you're going to back into giving you sort of whatever that runway looks like, right? I tell advisors that if you want to break away and you want to go into the RIA space, you need to give yourself 18 to 24 months of runway to prove that you can be successful here. If you're going to go out there and you think you got 3 to 6 months. So the exercise we have an advisor go through, and it's very simple. Think about all the client relationships you have and then color code them. Red, yellow, and green. It's not that complicated. Red, there's not a chance in hell they're going to come with you. They love the firm that you're with, and they're integrated in all kinds of other products, and you're just not going to get them. Yellow, they're on the fence. It's 50-50. Green, they're absolutely going to come with you. Then we have them go in and apply some additional handicaps to that, because there's going to be greens that will surprise you. There's going to be reds that will surprise you. And that should get you to that point where you can try to justify. My advice to someone looking to break away to potentially create their own company is, if you have a less than 100 million you think is portable, you should really think twice about whether that's the right path for you to try to go and build it. Because it's a magical number that could get you some lift in plugging into another company to provide that support mechanism without you having to, again, build the utility and all the other elements. So that's something that I think it's important.
I think, one of the biggest questions, or a couple of the biggest questions up front that advisors should ask themselves and be ready to answer is, look, being independent, do I fundamentally feel that it's what's best for me, my family, my team, my clients, et cetera? And do I like all the benefits of independence? But as Ryan alluded to earlier, maybe I just don't want to run my own firm. So would I be better off joining an already independent firm? If you then, ask yourself that question and say, yes, I do want to build my own firm. Do I really want to do it on my own? Is that the best use of my time? Or do I want to partner to help me do it? And again, those partners come in all different shapes and sizes. But once you've made that decision to do it, getting a lawyer, getting a consultant, an advisor to really make sure that you don't have any missteps. I think sometimes naivete, because a lot of advisors have their head down, doing a great job building their business within their current captive environment, and they might inadvertently do something that they create an issue around broker protocol if their firm is in protocol, or they don't know how to leave a firm that's already left broker protocol to go independent, right? And they haven't asked all the questions. Or sometimes we've seen advisors that might want to be a little bit more cavalier, right, and not follow that guidance. We strongly, when we're supporting advisors on the move, are very clear about the do's and do not. And we actually will not engage with somebody who we don't believe is going to follow our guidance, because we're going to be the ones having to deal with those mistakes on the backside. You mentioned the mapping earlier, Dave. Mapping everything. I mean, you really can, if you get started early enough, for the most part, check every box. If your clients have a particular type of loans, they have concentrated stock management or structured products that you want, or there's unique cashiering in terms of how you service or move money for your clients. There's SMAs, money managers or alternatives. You can map all of those in advance. Ask the questions, with the custodians, right, to make sure that you can run the business the way that you want. But if you do the due diligence, you put the time in, there's literally, I was asked this today by an advisor, there's literally today nothing that you can't do on the independent side that you can do in captivity. 20 years ago, some of the best asset managers, investment minds, some of the technology, the leading technology was in the big firms. Well, today, they're hedge funds or the asset managers who've moved independent, right? And they started a hedge fund, or the best minds have moved to starting an SMA. Some of the best minds are starting RIAs and going independent on the wealth side. And you can get product and capability and technology and capital widely available now on the independent side. So I would say do it if you're thinking about it. The biggest piece of feedback we get, Dave, from advisors is I should have done it sooner. And why was I so afraid This is something that they say they're now having fun again within their career, which is something that we're excited to be their partner to help them do.
And we got a question here, which probably relates to kind of some of that fear. Question here is, what's the most common compliance mistake you see when going RIA?
I've got a couple. Ryan, do you want to jump on that?
Go ahead.
Yeah, making sure that somebody completely reviews your employment agreement. Sometimes advisors, look, if you've been at a firm for 20 years, you may have forgotten about what you signed. And sometimes people are concerned about raising, some red flags of saying, I want my HR documents, et cetera. But having your house in order in that regards is really important. If you've inherited a book and maybe you've signed an agreement around inheriting that book, maybe there has to be a carve out with some of those clients where you might be able to leave under protocol for your legacy book. And there's different ways to approach what you can and can't do with the partnering agreements. Some people feel like that they're going to have a lot of time. There's some to pay back retention notes. There are certain firms out there that require you to pay it back immediately. So having that liquidity lined up, from a financier like a Dynasty to pay that back quickly is something that I've seen people misstep on. But it's really about just not getting the right guidance and experience in place. I wouldn't say that we've seen everything. We've seen most everything. But if you put a firm like us together with a great consultant like Ryan and a great lawyer, I think you're going to be in pretty good hands to get the right advice.
Yeah, I echo that. I mean, if it's, if the advisor comes in and it's a substantial client base that's going to really rub the firm the wrong way if they leave, we will help Bird Dog Legal for them in their particular jurisdiction in their state. So it's someone that not only knows the law, knows our industry, but knows that state. And because we tell them that what you want to be able to do is show a track record of paying an attorney to ensure that you did it right. And then you need to follow their advice. Right? Like, I mean, you talk about some of the war stories. It's the moron that sends an email to their buddy at the office on a Friday that they're leaving and they're going independent, and the manager comes in and gives them a TRO before they could actually get around to it. Like, it's just, be smart, keep this in a very, very tight, trusted circle until the time comes to let the lid off.
We got another question here, but Ryan, while we got you there, any other kind of mishaps that you've seen, maybe less in the road to independence, but in the, in another arena, whether that be, some sales or mergers that you'd throw out there for folks to be wary of? Yeah, I mean, I think, it's, our industry has gotten to where, an advisor believes that their business is worth what they think that it's worth. I think that, compatibility still comes into play. There's the mechanics of that business, but things that I've seen, again, I've seen some really ugly divorces in this business where they've gone down the path as partners to go out there and launch, and they've grown significantly. And then you start to really look around, right? And one is really achieving and they're producing, and then maybe another partner's not. And, what do you do if, Shirl and I are partners and we're 50-50 and, he's out there and he's running 3 laps around me. Right? I mean, you could just sit there and say, okay, you know what, look, let's be fair. Let's come back to the table, and perhaps I should be a 20% owner and you should be an 80% owner. But the truth is, the time to do all of that is on the front end. And a lot of it can be tied in around what's your strength and your weakness, right? We're all looking to leave this wirehouse to go independent. Which of us thinks that we would be the most competent wearing this hat? Right? So. And the question here, Ryan, actually piggybacks on that a little bit, which is, as a CEO founder who has 100% ownership, but then as you grow and start to hire additional advisors, the specific question is, what do you see as typical payouts off of AUM or revenue to those advisors? Is it based off of business that they're pulling in? Is it based off of clients that the CEO founder's handing off to them? Any kind of grid that either of you guys work off of there? I mean, I think there you've got to, the fork in the road is whether they're going to be W-2 or 1099. Right? The easiest way, what we see a lot in early days is we're going to do 1099. We're going to pay you some really generous portion of the revenue you generate. And then as a firm is either larger or puts in the right infrastructure with folks like Dynasty,
You then think about bringing on net new advisors, putting them on W-2, because you can dictate the way that they work and how they service the clients. But a lot of it also has to do with, are you going to own a stake in those clients, right? Are you buying a portion of that book to come into your firm, et cetera? So the payout levels are all over the map. I mean, we see firms that are paying 50%. We see firms that are paying 70 and 80. Now, you have to understand that if you're getting 70 and 80, you know, what exactly are you affording for that firm to be able to provide to you? And so typically they'll end up making another transition in their lifetime. When it comes to offering an advisor equity in a company you took all the risk to build, don't jump at that, and don't be desperate in thinking that's what you have to put on the table to get the win. Because you can't really unravel it. I'm a fan of sort of a phantom stock structure where if we exercise something down the road, you get to participate, but you're not going to sit at the table and dictate how we run this company.
Yeah, look, we've set up a lot of RIAs over the years, and there can be, you know, a lot of different customization, but in general, what we find is the founders of the business, you know, adding a bit to what Ryan was saying, will have some type of founder shares. You know, sometimes there can be a non-dilutable component. Oftentimes, and most typically, there's a preferred voting component to it, which allows them to maintain control for a long period of time, even if they're raising capital within that business. Advisors that come in that are affiliating, meaning they're not getting equity, that can be very different in terms of the payout, right? In terms of what they get in an advisor comp, than an advisor who comes in as a partner who's coming in as an equity partner. But if you're coming in as an equity partner, the way that you think about your total comp is both your advisor comp, which is typically what you produce, right? You're getting, whether it's 35, 40, 50, it's all up, it's customizable to the firm. That's tied to what you bring in and what you service. And then the second part of what you earn is your dividend that gets paid out pro rata based upon how much equity you own in the business. And what we're seeing most typically in our network is the advisors are setting advisor comp between 30 to 40%. And then again, as I said earlier, they're running a 65% gross income business. And if you have advisor comp set at 30, let's say, then that's 35% net income. That 35% net income then gets paid out as a dividend based upon the pro rata equity in the business. And if one advisor over time is out producing substantially others, you can issue more equity. And there's ways to do it that are more tax advantageous. We don't have time to get into all that detail now, but you know, as Ryan said, beginning with the end in mind, getting the right capital stack in place that allows you to be M&A ready and be in a position to add advisors is important if you can get that early on. Otherwise, it's a negotiated variable, down the road. Last thing is we are seeing the concept of a post-nup becoming even more popular, where somebody will say, look, I'm going to come in and I'm going to merge, but we're going to pick a period of time, whether it's 18 months, 24 months, 2 years, where we're going to strike the valuation and the merger at that point. But it also gives us an opportunity to date for an extended period of time to make sure that this is the right thing for us. Because if we ink the deal and have it be 100% acquisition and then it doesn't work, it can be very costly, not just financially, but emotionally. It can be tough on staff and clients. So we're seeing that structure become more and more prevalent.
It's been great, guys. One last question here that I think you'll both have something to say on. And this is interesting because I was just at the ETF Exchange Conference last week where Kathy Wood on stage mentioned 50% annual returns over the next 5 years. The question is, why do independent broker-dealer reps have less flexibility in the social networking and social media space than RIAs? It seems that RIAs are able to leverage much more of that. And certainly you see that. You see folks like Josh Brown and Animal Spirits and Charlie Bolello and others leveraging social media all day, every day. But you see, I think, advisors in the broker-dealer space that either aren't allowed to do it or they have controls around that. So love to kind of get some closing thoughts that you have around that topic.
Yeah, I would say, look, both Josh and Kathy are close personal friends of mine. I actually had them both on stage together at our investment forum in Nashville a couple of months ago. And Kathy's in our building here in St. Pete, followed us down, which has been great. I think advisors comparing themselves to Josh or Kathy, that's a stretch. I mean, they have me and Ryan and you, Dave, all beat all of us combined and throw in the next, 100 people on social media. We don't add up to their following. That being said, the simple answer is compliance, right? And again, I came from a large organization, and it's not the organization that doesn't want people to do it. They're afraid of giving everyone this ability, and then you have a handful of bad actors, right, that tarnishes the brand or gets a substantial fine that hurts everyone. And that's one of the benefits, again, when you go independent and you are running your own business, as Ryan said, you're now taking on some of those risks. So you're going to put in place policies and procedures that allow you, right, to customize how you want to engage on social media. And we have quite a number. I wouldn't say all of the advisors we support, but definitely more than 2/3 of them have dedicated social and digital marketing campaigns and programs to drive both brand awareness and client engagement, as well as client acquisition. I mean, if you know how to use search optimization, so that, we have advisors that we launch them within 90 days. If you search advisor in a major city in the country, they're going to be on the first page of Google. You just have to know how to do it and be able to drive towards it, right? You want to ultimately, if you're an advisor in your market, you want to roadblock the internet, right? If someone's looking for an advisor, they have to come through you first. And you don't have to have multi-million-dollar budgets if you know how these systems work. We run digital marketing campaigns targeted towards, executives that maybe just had an IPO, where for $500 on LinkedIn, we've run campaigns where we've picked up 25 million of new assets using simple AI technology that we deploy to engage with those executives, to line up meetings with our advisors, specifically with those executives. So again, we've hired people from places like Google that are on our team, and we've invested in that part of the intellectual capital. But the biggest reason is compliance. And I will say, to the question, whoever asked it, it is a growing reason, definitely growing reason, and probably a top 3 to 5 reason why we're seeing more and more advisors go independent, is they want more freedom and flexibility on how they engage clients, interact with them, and how they get new clients.
Yeah, I would agree with that. I think that it's simple compliance. And if you're running an RIA and you're the one that's wearing sort of that, that pseudo, CCO hat, you can sort of determine what comfort level you have. If you're an independent broker dealer with 5,000 affiliated advisors, you've got to be able to corral and police that. And so it's just a function of that. But I'll tell you, this RIA space, you're right. There's much more sort of socially active through social media. We recently helped an advisor leave an independent broker dealer because they wanted to be able to talk to clients about crypto. They weren't even allowed to be able to engage if the client asked them the question. So this particular advisor ultimately landed with an RIA who had more flexibility around their ability to engage in that conversation. Even though from a regulatory perspective, it's still gray, there's a willingness to lean into that conversation versus you can't have it. And I think there's so many valid points on why the RIA space is continuing to win.
Well, wonderful, guys. I think this has been phenomenal. I just shared my screen here with a few ways that some of the folks at Dynasty and the advisors in their network are using YCharts. But I do want to thank both of you so much for your time. Thanks, everybody, for joining us. Hopefully you found it educational from 2 of the greatest minds in the industry. Look forward to seeing both of you at future events later this year.
Awesome. Thank you, Dave. Thanks for joining, everyone. Good to see you, Ryan.
You too.